I think so. Faisal, you have also had a tough time today, and
Yes.
I think so. I also had a tough time today. So I can take it from there that there was a major glitch today, and now, but some noise is still there. But ignore it for now. Okay. So we are we'll have to figure it out. I think so. We can work with some part, and I think so people can hear us. So let's start rolling. And again, before I give a heads up, let me I wanted to go ahead with, can we hear you? Okay, so you are texting now. Can we please keep it within time? Okay, wonderful, not a problem, sir. I will try to wrap it up as soon as possible. So let's start. Okay, this is the monologue that I have for today, and let me start with that. And this is, again, ladies and gentlemen, thank you for joining and bearing with us for the glitch. Last week we had done some works on home buying step by step. So we are back on that particular same format, and we are this time covering step number 2. And so that is where we are. Let's start. So I'll start with my monologue, and we will be jumping right into the monologue today with home buying step 2 and 3. So that would be the first initial step. The second step is that we have this particular home buying step 2 is tremendously related to financial aspect of it. So we have our mortgage expert waiting for us almost like 15-20 minutes now to get us on board, and he will be there to on every step of the way there. So we are going to be working with him on every step of the way in this particular step number 2. And the last one would be rent to own homes, and with example. And at that particular stage, we can work on our own, and the mortgage broker has to timely go. We will let him go at that stage, and we will take it so that everything is going on smoothly there. Okay, so that's the update for today. So let's jump in there without wasting too much time, and let's get with our step-by-step guide today. So as last time, this is a Canada Mortgage and Housing Corporation home buying step by step, and I took you through the step number 1. Step number 1 was that, let's go there. These were some of the pages that were there in step number 1, and table of contents was there, and introduction was there, and is the home ownership right for you? So I went through some of the upfront cost, ongoing cost, major repairs, and we went into the detail of renting, pros and cons, buying, pros and cons. I took you through an example there, and that is where we were on last week. This is where we are on step number 2 for this particular week, and that is where we are starting our format today. Are you financially ready to own a home? Okay, so now let's see what this guide is telling us, and we will jump into it. It is important to figure out how much you can afford. It is an absolute must that we know where we are heading to and where we need to start. So these are some of the basics that we need to, and while I'm here, I'll give you a small analog analogy. That is, like, you will not go to purchase anything with your purse being left at home. Why? The reason is simple. You will not be able to purchase that thing. So the same format applies to when trying to purchase a property. You need to go and get know-how, a complete know-how on how much you can afford, what are your mortgage payments are going to be, what are the interest rates going to be, and various other smaller stuff. And these are called basic homework. So let's start with this one. Now, here is the first step that the guide is giving you is, how much are you spending now? Okay, now at this particular stage, these are some of the things that you can take a note on your own. Household expenses, what are your groceries, tuition, clothing, gifts, maintenance, childcare. Get a rough bit of an idea on it. What are your entertainment expenses? Loans and debts. What are your credit card, car loans? Try to go through these ones. And if you have any savings in RRSP, TFSA, saving account, or charitable gifts and stuff like that. I'm just going through on a cursory note on this one, because the next one that we are going to is the one which we will be dwelling into more. How much you can afford. Okay, so that's where we jump into it. And these are the two bases, and we will now take our expert also in it. I'll just brief you, and then we'll go to our expert on this particular one, and he will take us to the next level on these ones. Whenever you're trying to purchase a property, the lenders are trying to assess you on two bases. One is the gross debt service ratio. It is called the GDS. The GDS basically constitutes your mortgage payment. So what is your principal and interest, your property taxes, and your utility bills? So all these three will come under the GDS. And so you bet, and they want roughly around 32%. So now that means almost 1/3 of your annual gross income is the calculation for this GDS. Whereas the TDS, that is the total debt service ratio, is all your mortgage payment plus your car loans, credit card, line of credit, and other mortgage payments. So if you're holding any other property, they all form part of the basis of the TDS. And that is around 40%. I was having a word with our expert, and he is now going to give you, these are the basics that they will be, and he's now going to guide you with this GDS and TDS and the exception to some of the rules. So let's head to him and ask him if he can elaborate to us more on these GDS and TDS stuff ratio. Okay, we are here with you, sir. So I've given a brief on GDS and TDS. So now you take it to the next level and explain more in how it actually fluctuates, because you were giving me some various options there.
So GDS and TDS. So let's start with GDS first. GDS, the full form of it is gross debt service ratio. Now that includes your housing cost. Housing cost includes your so first of all, your qualifying payment, because depending on how much down payment you do, your qualifying payment is different if you're going for a variable rate mortgage or a fixed rate mortgage. But either way, there is a qualifying payment in case the so qualifying payment, principal and interest, plus taxes, and 50% of any condos or maintenance fee. So there are some condo fees, there are some maintenance fees in some properties. So 50% of that principal and interest, which is your monthly payment of the mortgage, and your taxes. All those items include in GDS, and that's all it includes.
Wonderful. So basically now I mean, the book, the guide is giving us, and as we were discussing, the guide is telling us 32%, that means almost close to 1/3 of your annual gross income is calculated as GDS. But you were telling me there are exceptions when you go into the exact with some lenders.
Exactly.
Explain me that.
Okay, so depending on how your credit score is and how your credit has been for the past number of years, you could get up to 39 GDS. Like 32 is what is preferred by the lenders and the insurers, but you could go up to 39 depending on how your credit is, how your payments have been, and not just score, but how many credits you have and you paid on time and so on and so forth.
And you were also telling me like you have seen some exceptions with exceptional credit scores and no loans that you could almost push it to close to 40 or 42%.
Yes, I have
Wonderful.
seen GDS go up to 42% provided it is a strong case. What I mean by strong case is there's a whole lot that an underwriter looks at, but it's case by case basis. However, I have seen up to 42%. Yes.
Oh, awesome. And okay, can you say it as a general rule or no?
No.
No, not a. It's a case by case. Huh?
Case by case.
But I mean, 39% would be like in case if you have good credit and everything, you can go ahead with that.
Yes.
It's a possibility. Okay, wonderful. Yeah. So let's get back to our example again. Give me 1 second. Let me go back. Okay, so that is where we were. So now, as per discussion, 1/3 of your income and the mortgage brokers with your good credit score and good credit score and report and a strong that you have very less loans and things like that, you may be able to go to the slightly higher ones. Okay, now let's get down to the next phase, which is called the figure out the upfront cost. Okay, this upfront cost we had discussed in the last webinar also, and we are going to go through it again on this particular one. Down payment, very important that we need close to 5% down payment. And now home inspection. Home inspection will be required. So it's like whenever you're trying to purchase a property, it is strongly advisable that you should do a home inspection. It will cost you between from $350 to almost $500 depending on the square footage of the property and from various companies. So, and appraisal fees. Yes, some of the lenders, I mean, I have seen they adjust that appraisal fee in there, and some of them charge you up front. So another $300 or $400. Now, whenever I'm on this appraisal fee, why don't I again take some input from the mortgage expert there? Give me 1 second. Yes, Faisal. So if you can guide me on this appraisal fee, what exactly stands, I mean, in there? Like, are you see what exact two things? One is what is the general cost there, and have you seen it is included in the mortgage, or you have to pay for it?
Okay, so there are 3 different types of appraisal. There's a desktop appraisal, which means there are comparables being used and a value is provided. Second one is drive-by appraisal, where an appraiser does the desktop, plus they drive by the property to see what the condition of the property is from outside. Then there is a full appraisal where the desktop is done and the appraiser goes into the property, takes pictures, so on and so forth. Depending on the level of appraisal, the cost could be anywhere between $9,900 to $500. What is the purpose of it?
No.
To make sure.
Yeah, go ahead.
The purpose of it is to make sure that lender is satisfied with the property to lend on, the condition of the property, and so on and so forth. Sorry, I forgot your question.
The main thing here is like the buyer has to pay for this appraisal, or the appraisal gets there is some adjustment that can be done with the mortgage lender.
Buyer sometimes buyer pays, sometimes bank pays, and sometimes insurer will do an appraisal on their own cost, even if the buyer chooses not to go ahead with that property in case they are in condition of financing. But no, buyer does not pay every time. Buyer pays sometimes. It's case by case basis, and lender pays sometimes. Sometimes your mortgage broker can also give you a rebate depending on how the scenario is and so on. So yeah, it's all possible, but buyer does not pay every time.
Okay, makes sense. Okay, let's go back to our scenario there. So basically, between home inspection and appraisal, I would say close to $1,000 would work it out. Insurance cost. Okay, you will have to do the property insurance, and the mortgage loan insurance is generally added to the mortgage. And we will be going into the detail on this mortgage loan insurance, which is the high ratio mortgage insurance, that we will come into it. But the property insurance will have to be like you pay yearly for it, and yes, you will be requiring that mortgage property insurance at the time of closing for that. Land registration fees. Now again, we call these under the closing cost. So the land registration fee, legal notary fees, these all will be formulating as the closing cost. And generally, as a thumb rule, for a first-time buyer, we go as close to 1.5% of the purchase price. Even in one of my last webinars, I had gone into the details of the down payment, the closing cost, and these various fees with examples. So if you go back on some of the webinars, you should be able to have a look at that particular one. This is another, the thing that they are trying to explain you here is, do not run very tight numbers. Keep some money up front, because there may be some surprise elements here. The surprise element being prepaid property taxes and utility bills. So let's say suppose the seller has paid the entire property taxes for the entire year, and you are closing in the middle of a month. Let's say suppose even in November you are closing, and the seller has paid the property taxes up to the end of 31st of December. So there are some adjustments that will have to be done, and same thing with the utility bills. Again, the sellers may have paid the utility bills in advance, and then you are closing somewhere in even before the end of the month, and then there will be adjustments. So prepaid property taxes and utility bills, and those fees you may be expecting, no, once I close the property, then those charges will keep on coming, but you'll be surprised that they may come over as upfront cost. So you have to be basically prepared. Another important thing is moving cost. So yes, you should get some basic idea when you're trying to purchase a property, how much are you going to be moving costs, because that has to be there. And these are that's why keep some funds extra apart from the down payment and the closing cost, because some of these stuffs will come in over. GST, HST. Now for resale properties, the GST, HST is always included in the purchase price, but for new built homes, so if you're trying to purchase a new built home, then this one comes into factor also. Okay, so that gives us a bit of an idea about the upfront cost. So again, all these links of these handy guide, home buying guide, is in the live streaming and show more, so you can see all of them at the bottom there. Okay, let's go get to the next step. What should you do next? Okay, now upfront cost, and we are calculation number 4. How will your budget look as a homeowner? again, we gave you a brief on this one, that it is 1/3 of your GDS and 40% of your debt, total debt ratio. So TDS should be around 40% and GDS around 32%. So we have given you. So 1/3 is basically a thumb rule that you can work with, is the calculation for the mortgage payments, utilities and taxes. Now, very important, and these 4-5 of them are the ones what you should do next. If you can afford the home you want, you're good to go. But let's say suppose if you have trouble making mortgage payments or you're concerned about your finances, this is where this particular gentleman or the mortgage experts comes in handy. He is, now let me also see if I can take you to one of his web links and give you a guide there, and that is what we are going to do in the meantime. So give me 1 second here, and in the meantime I'll explain you. I will take you over to 2 of his websites one by one, and they will help us in order to understand where we are and where we are going to. Okay, let's go there. Okay, we are now meet with a credit counselor. So yes, when you will try to go and talk to a mortgage broker or a lender, he will be able to guide you. Your everything looks okay or something is out of shape. He will be able to assist you there and walk you through, okay, these are some of the things that you need to do in order that he can procure a mortgage for you. So that is where a credit counselor or a mortgage broker or a person who's an expert with credit repair can help you out. And our mortgage expert, Credit Faisal, does all of these stuffs, so you'll be very handy to have him on your side. Look at your current budget, spend less or save more. Okay, you can work on this particular format, that for a certain period of time when you're trying to purchase a property, you can start curtailing some of the expenses and trying to save you more for the down payment, because it is a very big procurement that you're trying to do, and you will have to work out all your numbers from all the angles. So carefully look at your all your mortgage, all your loans, debts and everything, and you should be able to get you to the next level. Pay off some loans. Yes, if you can, this is an idea. Pay off all your loans, bring that your credit score and everything so that you can qualify, and then go back to maybe procuring funds or cash back so that you can help yourself out down the line. There is a cashback program that I've been explaining from a few of my other webinars. Now the next one they say is save for a few more years for a larger down payment. Okay, I am not 100% with this particular one, and I'll explain you why I am not there with this particular one for the entire thing is because by the time you're saving for 1 year or 2 years, and let's say suppose you're able to save another $25,000 or $30,000, the value of the property has gone high by 25 or 30. So it is in your interest, if you can procure it right away, it is advisable. Go for it right away, and with the trend that the market is at the moment right now, and that is why I would give it a 50-50 chance on this particular one. Save for few more years, because the values are going crazy, and by the time you save, you are not even able to qualify for that very amount that you were thinking that you would be able to get. Lower your price range. Yes, again, this one is also a 50-50 from my point of view. Yes, you may be willing to purchase a property with a lower price range, but as I have told you in my previous webinars, after you have done, this is our fourth challenge, even if you have done everything, finding a property in your price range is not an easy cup of tea. So that is where I would be giving it a 50-50. So yes, you may be ready, but the market conditions may not be ready there. Okay, so let's cover the next one. Okay, and there is, remember, your first home does not have to be your dream home. I am very strong advocate for this, that get started, because the main thing here is, even if you pick up a property which is not your dream home, you will be able to save a good amount of your rental income and spend 2-3 years there. You will have enough equity and enough down payment to move over to a next level. And I with my experience with many of my clients, they've made so much of good money with the purchases of real estate, because that is how I have been explaining. Real estate has become a second income, and it has become, and sometimes even it is more than your regular income. So once you have, so you are now able to work with your one income and the real estate as second income, and you are able to go to the next level. So yes, this one is a strong advocacy. A few changes in your monthly budget or your expectations can go a long way towards making your dream of home ownership a reality. Absolutely true. Get into this house bandwagon and you will be happy with it, and you will thank your professional there, and that is where things are. Okay, we managed to complete step number 2 today. Let's head on to step number 3, and here we will be guiding